Today we're going to be looking at FleetCor Technologies, ticker symbol FLT. Stick around. So before we get started, I just want to say, if you find these kind of videos helpful, let me know in the comments section. Are there any particular companies you want me to do an analysis for? And also, I'm trying to hit a new record of 30 thumbs up. So go ahead and give me a thumbs up right now. I'll wait. So FleetCor is a global business payments company in the Fintech space based out of ATL, Georgia. The ATL, Georgia, man.
Welcome to Atlanta where the players play and we ride on.
Their products help companies control, simplify, and secure payments. So instead of using cash, checks, and credit cards, you can use FleetCor's products. And those products allow the customer superior convenience, reporting, and security. So imagine if you own a business and you have employees that are traveling around getting fuel, paying at parking sites, going on toll roads, staying overnight at different places. You need to pay for all those expenses and keep track of them. You also want it to be done in an efficient manner. If at the end of a month you have a mountain of receipts that you need to pay an employee to go through, there ends up being a good opportunity for theft or fraud due to the sheer volume of transactions. Or even take the parking, for example. If you have employees looking around for free parking for 10 minutes, then walking 5 minutes to a job site, then walking back for 5 minutes to discover a $20 parking ticket, I mean, that's going to eat into your profits. That costs the company more money than you might think. And it's probably not going to get brought up a lot by the employees. And the employers and managers might not be thinking in those terms. So that's where FleetCor comes in. It helps solve some of that hassle, among other things, and tighten up some of those inefficiencies. They have 5 distinct aspects to their business: fuel, general payables, tolls, as in toll roads, lodging, and gifts. Fuel is by far the largest aspect of their business, being about 43% in the first quarter of 2020. They offer solutions for buying fuel and managing expenses. They offer various products including fuel cards, RFID tags, and vouchers. Their tools help prevent unauthorized purchases, cut reimbursement issues, and automate transactions. They also help with record keeping and streamlining the accounting process. Their products are accepted both within their own networks and with other networks like Visa and MasterCard. Their fuel business operates not only in North America, but in Europe, Brazil, Russia, Australia, Thailand, and the Philippines. The payables aspect of their business represents 18% of their revenue. They offer payment solutions and automate and simplify the accounts payable process with virtual cards, corporate cards, and payroll cards. With a presence in North America, the UK, and Australia, this aspect of the business has a lot more room to grow. The tolls aspect of their business, which represents 13% of revenue, makes payment for tolls, parking, and fuel quicker and easier using RFID technology. Currently, this feature seems to be mostly available in Brazil, which again is a lot of opportunity to grow. The 4th aspect of their business is lodging, which accounts for 9% of revenue. They offer deep discounts at over 15,000 hotels across North America. These solutions are ideal for companies that do a lot of traveling, like railroads, trucking, emergency response, construction. This aspect of their business has yet to expand into Mexico, the Middle East, and Africa, but pretty much is everywhere else. So one way they measure the lodging aspect of their business is in nights reserved for a particular year. So they had 27 million nights reserved in 2019. That's a lot of sleep! FleetCor also offers gift card management and processing services in 61 countries. This is sort of a white label gift card service for their clients. Can we say that? Is that racist? They handle all aspects of the gift card, from promotion and packaging right down to the analytics. This accounts for 7% of their revenue, and they handle more than 1.4 billion transactions a year. FleetCor has achieved an organic growth of 2% in fuel, 20% in payables, 10% in tolls, and 5% in lodgings. Organic growth excludes acquisitions, so this is not their total growth in those areas, but growth that excludes companies they've acquired. However, much of FleetCor's growth historically has been through acquisitions. And acquisitions are generally somewhat looked down upon as a method of expansion, but FleetCor's ability to amalgamate those companies into its core business is pretty admirable. And these acquisitions have allowed them to expand their footprint into areas like Brazil with Semperar, or the UK with Cambridge, or expand their digital footprint with companies like Travelliance, and expansion and growth seems to be in the sights of CEO Ron Clark. Ron Clark has been with FleetCor since August of 2000, and he's been a huge factor in their incredible success. But of course, with incredible success, sometimes comes incredible pay. In 2017 alone, he earned $52 million, and that large pay did not sit well with shareholders. In early 2019, his pay was reduced to $7.8 million, which is more in line with a company of this size. While all of this is supposed to be a bit scandalous, it's important to reiterate how well this company's been doing and that Ron Clark has been leading that success. Also, his pay is based on performance. So in all fairness, he's like 64 years old. Most of us get used to and adapt to our level of pay. So it seems a little cold-hearted to cut his pay so drastically at this point in his life. But on the other hand, it's in our own best interest and it's good for the shareholders like you and me. So I can't really complain. Oh, something looks different. What could it be? Well, it may seem as though only a few seconds have passed, but through the magic of YouTube, it's actually been a few days. And that's because my life kind of looks like this. Right? You can see him die inside. You can see him die inside. And that happened to me. Yes, that was fun. So I only have certain days to film these videos. So anyway, let's move on to acquisitions. So one of FleetCor's recent acquisitions is NvoicePay for $208 million, which is a provider of full accounts payable automation in the US. Also R2C, which is a fleet maintenance compliance and workshop management software provider in the UK. Sol Financial, which is a payroll card provider in the US. And Travelliance for $110 million, which is an airline lodging provider in the US. What about dividends? As far as dividends go, they don't pay one. Normally I don't focus on dividends, but I'm only mentioning it because a lot of younger people nowadays are concerned with dividends and invest like they're 80 years old, where dividends are a big important factor. So if you're primarily a dividend investor, this company isn't for you. This is kind of a smaller growth company. So far this year, thanks to the Roni, Rigatoni, this stock is traded as high as $329 and as low as $168. Their share price is currently $238 or 27% off their high. Now, because of how percentages work, and this is especially important to keep in your memory bank during periods of high volatility, such as we're experiencing right now, a 27% decrease is actually the equivalent of a 38% increase. I think a lot of new investors don't notice that important distinction, so let me say it one more time. A 27% decrease is the equivalent of a 38% increase. So how does that work? Well, if a stock is worth $100 and it falls 50%, you have a $50 stock. But if a $50 stock increases 100%, it's a $100 stock. It's doubled in value, if that makes sense to you. So it's the same numbers, but different percentages. So let's have a look at the revenue. Of all the countries that FleetCor operates in, 65% of their revenue comes from the United States, with Brazil being the second largest contributor at 15%. And with all the different aspects to their business, such as toll roads and lodging, 43% of all their revenue comes from fuel. Revenue has increased steadily since 2010, and their net income has similarly mirrored their revenue increases. So why does that matter? Why does it matter if the revenue is increasing with the net income? Revenue is just the money that the company is making, and it says nothing about what a company is spending. If your revenue increases but your expenses increase more, then that starts to eat into your profit. And if that's what's happening, it may actually be a bad thing for your business to increase or for you to scale that business, because you'll just go in debt quicker. At least it would be if there's no plan in place to correct that issue at some point. So to see the revenue and the net income increasing together steadily is a good sign. So what about net margins? Although they're usually up in the 30% range, they have in the past dropped as low as 21%. There was a period between 2015 and 2017 where they were in the low to mid 20s. Currently they have a net margin of 32%. That's pretty good. Even a net margin of 20% is pretty good for most businesses. So why does that matter? Net profit margin is simply net income as a percentage of revenue. So it tells you what percentage of all the money that came in, the revenue, is kept by the company, the net income. If a company has a habitually low net margin, it means that they have very little wiggle room when it comes to posting a profit. Restaurants generally have very low net margins, and that's why an issue like we're experiencing right now, can be so disastrous to that kind of a company. So let's talk about market cap. FleetCor, with a $20 billion market capitalization, is technically a large cap company. But that's a bit of a misleading designation. Maybe I'll make a video about this in the future. A company's market capitalization size is meant to determine a degree of risk based on the size of the company. A smaller company would have a higher degree of risk, and a larger company would hopefully have a lower degree of risk. But the issue is more with the measurements. They're sort of old measurements. So if I could quickly sum up the issue, a company like Apple has a net income, meaning they keep all the money. Their net income is 2.5 times bigger than FleetCor's whole market cap, meaning what the whole company's worth. And yet they're both large cap companies. So that's somewhat like saying that a spring salmon and a megalodon are both large fish. Yes, they are, you're correct. But a megalodon could eat several spring salmon in one single bite. So how relevant is that information? Sorry, I just watched the movie Meg, starring Jason Statham, about a megalodon. And you know what's interesting about that movie is, in movies, a lot of people, they're doing they always do, like a pretend run. Like, oh, I'm running from a dinosaur. But Jason Statham, what he does is he actually runs. So it looks like he's really fast compared to everybody else. He looks like an action star because he's so much faster than everybody else. People be like, oh, what's that, a megalodon? He'll be like, a megalodon.
One eternity later.
So what about free cash flow? To a lot of investors, this is a pretty important metric. Although their free cash flow in 2019 is about $12, their free cash flow per share over the last 12 months is actually $30, which means that FleetCor is currently trading at just under 8 times price to free cash flow, which is historically pretty low for them. The price to free cash flow metric takes into account 2 variables. Sorry, my English friends. So a low price to free cash flow could mean either that the cash has increased or that the price has plummeted. Now, in the case of FleetCor, both of those things have happened, which is a really good thing for the investor. You want there to be a low price, and you want them to have a lot of cash. The market is worried and is therefore pricing this company in the low range due to the 2020 crisis. Meanwhile, the business as of March 31st is doing better than ever. And although it will be impacted by the global situation, it should bounce back in line with the economy. So speaking of the global crisis, what if FleetCor just is loaded with debt, or they don't have enough cash on hand to weather the storm? Well, let's look at their balance sheet. They have $1.5 billion in cash on hand, and their net income is nearly $900 million. They also have $4.1 billion in total debt, which means they could pay off all of their debt in a very short period of time if need be. But much of that is in long-term debt, so it doesn't need to be paid anytime soon. Their retained earnings of $4.86 billion have steadily increased since 2008, which is as far back as my records go. FleetCor's retained earnings for the period ending March 31st, 2020 have grown at a rate of 21% year over year. And 21% historically for FleetCor is pretty low. But for most companies, that's really good. Retained earnings on the balance sheet is an accumulated number, which means that if a company invests into itself, that number goes up, and if a company loses money that year, then that's subtracted from retained earnings. So if a company over time is growing its retained earnings and therefore growing its net worth, that is a good thing, and that is exactly the case with FleetCor. So FleetCor has a presence in Brazil, which puts it in competition with another company I've done a video about, which is StoneCo. So if you haven't seen that video, you should probably go check it out right now. It's really good. So for instance, in 2018, it became possible to use FleetCor's toll cards, known as Sem Parar, to buy McDonald's food. Sem Parar provides automatic payments for clients while they're in their vehicles and has 5.4 million monthly active users. So some of the toll road card's uses are for toll roads, parking, gas station, drive-thrus, and car rentals. So I don't think they're in direct competition, but there's obviously some overlap. I think it could be possible that a company like FleetCor decides to buy a company like StoneCo in the near future. And of course, StoneCo is the smaller company and only has a presence in Brazil, FleetCor being the larger company and having a presence elsewhere. Buying StoneCo might eventually be part of their plan to break into the Brazilian market. So let's go over some of the risks. And honestly, a lot of these risks wouldn't be that big of a deal in a normal situation, but because of the Roni baloney, a lot of them are accentuated, at least for the short term. So some risks involved with FleetCor's business model would include changes in the price of fuel. If fuel is cheaper, then FleetCor will make less money off of their fuel aspect of their business. You could also assume that if oil companies are going bankrupt, that could be a big problem. FleetCor has a lot of partnerships with oil companies, so although I think they're the larger oil companies, which probably won't go bankrupt. And if the economy is slowing down, then that could cause the amount of commercial vehicles on the road to slow down, which would be a negative impact on their fuel aspect of their business. In a similar fashion, the lodging aspect of their business will probably be impacted pretty hard as well due to the 2020 crisis. People just aren't traveling as much for business, and a lot of businesses are allowing their employees to stay home and work from home. So at least in the short term, that'll eat into those profits, I would think. Also, their customers could end up going bankrupt or simply not paying their bills. Despite FleetCor's best efforts, these type of things can happen, and in a situation where companies are being forced to close their doors, could happen all the more. Another very real risk factor is the highly competitive nature of each of their undertakings. Even in the best of circumstances, each of these areas is a highly competitive field, although FleetCor's done an amazing job in navigating that issue so far. However, FleetCor is not the biggest name in the game when it comes to any area of their business. So it's important to bear that in mind when considering potential future risks. And what about a company like Tesla? Electric vehicles could, in the future, displace commercial vehicles that run on fuel. That could probably impact FleetCor's business quite a bit, but how close are we to that actually happening? I don't know. I know a lot of people out there love Tesla, and especially people in my age group, there's a lot of Tesla fanboys. But I think we're a long way from electric vehicles actually taking over the commercial vehicle market. And with the country entering into a recession, even if it's short-lived, I doubt a lot of companies are rushing out to exchange their commercial diesel trucking fleet for an electric equivalent. And even if things do go electric, FleetCor may still be able to adapt into that environment. So in summation, what do I think of this company? I really like FleetCor. I like them a lot. I spent a lot of time looking at their financials, and there are not a lot of companies out there that look this good financially. I think their business will obviously be impacted by the 2020 crisis, but how long or deep that impact will be, it's anyone's guess. I think this is a great opportunity to acquire a historically great company at a reasonable price. And in the short term, a lot of people are expecting a market pullback, so the potential to pick this company up at an even better price is probably pretty high. Now, this company only recently came on my own radar, so I'm currently looking for a good entry point myself. So if you take into account all of the future potential risks, but also the degree of a discount we're getting at this price, I think it's pretty good. Whether you agree with me or not, I think FleetCor is a great company to add to your watch list and think about picking up. Anyway, I hope you enjoyed the video, and if you liked it, add me to your watch list by hitting the subscribe button. If you like what you saw, give me the thumbs up and subscribe. And don't forget what I told you.